Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're going to connect three things that might seem completely unrelated: the Japanese yen, United States Treasury bonds, and the interest rate on your next real estate loan. These are a lot more closely connected than you might think. Now, the Japanese yen has been under extraordinary pressure. It recently traded near 164 yen to the dollar, a level not seen in roughly 4 decades. Japan and the U.S. responded with a rare coordinated intervention designed to strengthen the yen, and for a few days it worked. The yen strengthened to around 155 to the dollar, but here we are less than 2 weeks later, and the yen is back near 159. So why should a real estate investor in Dallas, Atlanta, Phoenix care what happens to the Japanese yen? Well, it's because Japan is the largest foreign holder of U.S. Treasuries. The latest Treasury data puts Japanese holding at roughly $1.2 trillion. When Japan wants to defend the yen, it needs to buy yen and sell foreign currency assets. Those reserves include their enormous portfolio of U.S. government securities. Now, Japan doesn't necessarily have to dump treasuries in the open market. In fact, the Federal Reserve has a facility specifically designed to prevent that from happening. It's called the FEMA Repo Facility. It allows a foreign monetary authority to temporarily exchange treasuries for dollars, effectively a borrowing facility where those treasuries are collateral, and they're borrowing from the Federal Reserve. Now, the Federal Reserve explicitly says one purpose of the facility is to support the smooth functioning of the treasury market by providing an alternative source for dollars. When you think about what that tells you, Washington understands that forced selling of treasuries by a large foreign holder could become a problem. Bond prices and bond yields have an inverse relationship. If a major holder starts selling treasuries, all other things being equal, the price for those bonds will fall and therefore yields will rise. And this is happening at a time when the U.S. can least afford another large source of selling pressure. As I record this, the 10-year Treasury yield is around 4.6%. The Treasury just auctioned 30-year bonds at 5.22%, the highest borrowing cost at a 30-year auction since 2001. The government already needs to continually refinance enormous amounts of debt while simultaneously funding new deficits. So imagine adding a $1 trillion foreign holder that suddenly needs more liquidity. Japan would obviously not sell $1 trillion overnight. That's not the scenario. But the issue is what happens at the margin. You see, bond markets establish prices at the margin. If investors believe that one of the world's largest treasury buyers could become a persistent seller, they might demand higher yield in order to absorb that additional supply. That higher yield then travels through the entire financial system. And this is where it gets directly relevant to you and I as real estate investors. People think the Federal Reserve determines mortgage rates, and that's not really true. The long-term real estate financing is influenced by long-term Treasury yields, specifically the 10-year Treasury. It's determined by credit spreads and the mortgage-backed securities market. The yield on the 10-year Treasury is an important benchmark for commercial real estate and for residential mortgages. So the Federal Reserve could eventually stop raising short-term rates or even lower them, and the long-term borrowing costs could be completely disconnected from that. We've seen that repeatedly over the last several years. And so this is a very real risk that investors need to understand. The yen problem could contribute to a steeper yield curve where short-term rates decline, but long-term rates remain elevated. For developers, it could mean that construction financing, those short-term rates, could eventually improve, but permanent financing remains expensive. For apartment investors, higher long-term rates translates into lower debt proceeds because debt service coverage becomes the limiting factor. And when debt proceeds fall, equity requirements rise. Then cap rates, of course, have to adjust. A property that made sense with permanent debt at, say, 5% would not necessarily make sense at 6 or 6.5%. You either need to lower the purchase price, you might need higher net operating income, more equity, or some combination of all three. So this is why I keep saying that interest rates can't be analyzed simply by watching the Federal Reserve. These capital markets are global, and Japan has spent decades accumulating enormous foreign assets because Japanese institutions need returns that were difficult to obtain domestically. This is the so-called Japanese carry trade, which we've talked about even recently on the show. The intervention material we've been studying makes the point that squeezing speculative traders doesn't change the structural movement of the capital. If the yen stabilizes, well then maybe much of this concern disappears, but if it doesn't, the choices become progressively more uncomfortable. Japan could intervene again. It could raise domestic interest rates more aggressively. It could access dollar liquidity against its Treasury portfolio, or ultimately sell some foreign assets, but every choice has consequences. Now, we shouldn't, as real estate investors, panic about Japan, but we definitely want to pay attention. The lesson is to recognize that the interest rate environment is being influenced by forces much larger than the next Fed meeting. You want to look at what happens if the 10-year Treasury stays above 4.5%. What happens if your permanent loan is a full percentage point more expensive than you expected? What happens to your valuation if cap rates move another 0.5 percentage point? The best time to discover your deal can survive those higher rates is before you buy it. As you think about that, have an awesome rest of your day. Go make some great things happen. And we'll talk again tomorrow.